And this is Lance Bryce with Thrive Mortgage. Today is the 22nd of March, Wednesday. I hope you're doing well. We moved this call up to Wednesday today to talk some about the Fed. The Fed just concluded their two-day meeting. They did raise rates today, the overnight lending rate, the federal funds rate by a quarter of a discount point. That has actually helped us quite a bit interest rate-wise. We are down to, in the Mortgage News Daily Tracking Index, 6.45% today for a 30-year fixed conforming nationally. That same index had us at 6.75 yesterday. A month ago, y'all, we were at 6.88. So your $400,000 mortgage a month ago, you could borrow $418,000 today for the same monthly payment based on that movement just over the last 30 days based on the news we got from the Fed today. Here's what they did. They did raise the federal funds rate by a quarter of a discount point. Y'all, bond traders had already factored in an 83% likelihood that that's what the Fed would do. One thing that Chairman Powell has done is he has really stayed within the market expectations for future rate hikes. At each of the 9 meetings over the last year plus that they have raised rates, he stayed right in line with what the market predicted as far as what the Fed would do. So if folks want to know what Jerome Powell is going to do, the market predicts it very accurately based on the fact that his statements are pretty transparent. And he's done a good job, frankly, of communicating that. Y'all, that doesn't mean I'm endorsing the Fed or even the existence of it. I've got a lot of views on that I'd be happy to share with y'all individually if you want to call me and visit with me about it. But as far as communicating to the markets and not delivering shocks to the marketplace, the Fed's done a decent job of communicating what they plan to do in a way that doesn't shock the markets, and that's what they've done here. Prior to the banking crisis that we've experienced over the last few weeks with the failure of Silicon Valley Bank, y'all, we were seeing inflation reports that were frankly ramping up the possibility that the Fed was going to be more aggressive. So we were looking 30 days ago at the possibility of a half-point hike at this meeting and then 2 additional hikes by the end of the year. And the market was already pricing that possibility into interest rates and into bond prices. With the banking crisis resetting expectations around that, we knew the Fed was going to moderate in some way at this meeting. And then going a quarter of a point is probably the best middle ground we could have hoped for out of what the Fed did today. They did, however, make one very important change to the policy statement. That is, they removed the statement of ongoing increases from the policy statement. This is probably the most parsed release that any quasi-governmental agency like the Fed could possibly ever release, the Fed minutes. So they know exactly what they're doing when they remove or modify the statement in any way. And when they take out 2 words that indicate a continued hawkish stance on future hikes, the market immediately responds to that, and that's why we're seeing nice improvement in rates today. The likelihood now that the market is pricing in is that the Fed will go 1 additional quarter of a point at their next meeting and then pause. So that's the expectation. And remember, when Powell sees the expectation and sets the expectation, he has, at each of the prior 9 meetings, fulfilled that expectation without going beyond. So I would be very surprised if we didn't see exactly that going forward. And that's the reason that you're seeing better interest rates today. The Dow, however, did not get everything they wanted from the Fed statement. The Dow was frankly looking for more support for the banking industry from the Fed. They would have liked to have seen language that included some more specific backstop for investors. Specifically, they would like to see the FDIC insurance per account raised above the $250,000 current max. They would like to see that institutionalized. The Fed did not address that at all in the minutes, and the markets would have liked to have seen that. When I say the markets, I mean the Dow. The Dow's down 530 points today. It's down a little over 1,000 points, 1,120 points over the last 30 days. And that's owing primarily to financials suffering in this current banking crisis. When you have regional banks borrowing the kind of money that they're currently borrowing to stay afloat, it is a scary time in financials and in the banking industry. And the Fed is having to acknowledge that fact. The one thing that Fed increases do is they do have a very negative effect on the very typical model that banks rely on of being able to take in deposits and pay a low rate of return to those depositors and then lend that money out in a long-term way for higher yields back to the bank. That has been turned upside down with these Fed hikes. That's owing primarily to an inverted yield curve where shorter-term maturities are frankly paying a higher yield than longer-term maturities because of the pace of these hikes. So when we see that scenario, it is very damaging to the banking industry. The Fed has to balance fighting inflation with harming banking. And they are choosing to kind of walk that line right down the middle and gave us what we were expecting today with the bonus of moderating where we're going to be later in the year. Now, expectations are we're still going to see better pricing later in the year. But as we have stated repeatedly, if we wait for interest rates to come back down in the fives, if they do, as expected, you're going to be competing at a level that we were competing for housing back in 2021, where every property is going to see multiple offers. We're going to see no flexibility in sales price or in sales concessions that can make the critical difference in buyers being able to get not only the house they want, but to get it at all. So as we have said so many times in the past, be willing to marry the house and to date the mortgage, right? Buy houses while they're still available. Buy houses while you've got a market to choose from. Take the one that you want. And then if rates improve by the end of the year, refinance it. We'll be there for you to help you do that. So in any event, hope this information is helpful for you, for your clients. Feel free to reach out to me. You've got my numbers on the screen. Have a great week. Be blessed. We will talk to you soon.